Good morning, ARMR Insiders. Thanks for ending your week with me this morning, getting ourselves ready for the trading session. Today, we're going to go over trades we're making on the ARMR Live Trading Desk during the day, in the indexes yesterday, in VIX. We're going to go over what we did yesterday, what we're going to be looking for to trade today. We're going to talk about big picture again, because I think it is really the most important way for us to focus on what's happening here and not get lost in all of the noise around us. We're going to look at a chart of the bear market of the 1969 bear market, and it's going to be a bit of a guide. History doesn't repeat, but it rhymes, right? So just a bit of a guide and some thoughts off of that. And then what my strategy is when it comes to short selling, and whether or not we want to make that a position in a portfolio that we hold overnight as a swing trade. Something I haven't done so far, but I'm beginning to mull this idea. Like any idea at the ARMR report, it starts with these, three steps, right? The three essential stages of ARMR investing. We take a research idea, we put it on the whiteboard. We don't put it in the portfolio right away. So going to the whiteboard, excuse me, right now for me is the idea of building in some shorting into our portfolio as an investment. I'm sharing with you my own personal approach. I go over my 4 portfolios and how I'm investing. Use it as a guide. Do your own due diligence, risk tolerance, goals, all those other things. I like to start every morning with this chart, just to tell me where I am in the picture, okay? I want to show you two charts again, just to remind you, all right? Here's the bottom of the market. This is a market that went up, not because we're all brilliant, not because the economic cycle was some wonderful thing, none of that stuff. The market did this because the Fed added massive amounts of liquidity. The market did this because the U.S. government sent checks in the mail to everybody in the country. And a lot of those people thought, hey, what fun. I got an extra few $1,000s. I'm going to throw it into the stock market, okay? None of that's real. It's an aberration, okay? It would be totally normal for this top to erase all of this. Not sure I'm right about that. Take a look at the ARK funds, okay? So now ARK has completed the ARK, if you will, all right, and given back every single penny of the rally induced by Fed largesse, okay? That's what's happening to the market. Now, who knows? Maybe the S&P doesn't make it all the way down to the bottom. Maybe not. We're going to read and react here at the ARMR report. I don't make predictions, right? But I can tell you that is the worst case scenario, what's going to happen, probably to the market. And if we go take a look at treasuries, we're going to see treasuries have already gone below, dramatically below where they were at the start of the pandemic. Okay? So treasuries not only have wiped out the Fed action on the pandemic, right? But they've gone to new lows, dramatic new lows. You put that together with the ARK type of experience and the head and shoulders top of the S&P, and that should get your mind right as you come into investing, you come into trading today. So now let's take it down to what's our day trading posture? How are we going to handle the markets? Okay. Every day I come in looking for the long trade on the S&P, but I'm willing to short the market. Let's go to the videotape, as Warner Wolf used to say, and look at our trades from yesterday. All right. So first of all, let me talk about VIX. Okay. VIX has been a holding. So right now we're looking at a 3-minute bar chart. This is how we day trade all the lines of the ARMR algorithm, the ARMR PMP, price movement profiler. Excuse me. Volume weighted average price, VWAP, that's the black dots. Fibonacci extensions above and below opening ranges, average true range above and below, ARMR moving average, the yellow line. These are all the things we use. There's locations we use. And then from these locations, we look for the 5 ARMR buy triggers or sell triggers, depending on how you look at it. Okay. So we came into the day long VIX yesterday. This is the gap up in the morning. Okay. And we exited every position on this bar right here. This bar right there took us out of all of our VIX positions, and we did not revisit the position all day. Even when it rallied up here, we didn't own VIX. And here's the collapse in the last hour, particularly in the VIX Volmageddon rip higher of 2020. So even in the most bullish time for VIX, 3 o'clock is the witching hour. There are multiple examples of the 3 to 4 o'clock dump that we saw yesterday in VIX. It's the most dangerous time to own VIX. 2 times that you're going to see the ARMR report hold VIX overnight. 2 conditions. Number 1, VIX breaks out of that channel to the upside, and the melt up begins as the market's cratering lower. Okay? The Volmageddon trade that we saw from 2020. If that happens, I'll start holding it overnight again. If VIX goes back down to the lows of this channel, take a look at this green box in here where we bought VIX the last time. Okay. We are going to do a Brian OG trade. It's a shout out to you, brother, because you've hit it twice now, and you're absolutely right. I don't know if Brian's going to do this again, but he had a buy stop out on VIX at the bottom of the channel. He gets filled and bam, makes money. I love that idea. VIX at the bottom of the channel, I'm going to be all over the Brian OG trade, or VIX breaking out of the top of the channel, and I'll start holding it overnight. Other than that, I have no interest in VIX right now, and I'm not even trading it during the day. Okay? So what am I doing during the day instead? Okay, I'm not trading VIX. And so on this rally here, it's like, well, you could have traded VIX. I could have traded VIX. What I chose to do instead, and we had much success doing, okay, was shorting the market. And this is stage 2, execution algorithms. We don't make these decisions on our own. We don't just come out with a gut feeling, I think I should be long the market. The risk monitor changes, I get long. It's not changing right now. But I wanted to show you a chart, and thank you, Miguel, for posting this in the Slack room on our virtual hedge fund floor. I wanted to show you this chart of the 1969 bear market. So this was at a time when inflation was starting to get out of control. You had, coming down the pipe, stupid regulation from government officials to try to control prices of commodities. I wanted to show you this chart. Thank you, Miguel, for putting this into our Slack room. Okay. Here's a chart of the bear market of 1969. I wanted to show you this because, yes, it was a horrific market, but notice here and notice here, there were tradable rallies, right? This is a weekly chart. So there was a few months in there where the market went up and then it cratered again. There was a few months in there where the market went up, or a few weeks, right? And then the market cratered again. So there will be a moment. There will be a window when the market rallies. It's a counter trend bear market rally. So this was the original top, the breakdown, and then the rally. Where are we in that cycle? I submit to you that we've already seen that rally this year in the S&P, okay? So this is the top breakdown, and this was the first rally. It didn't last very long, okay? Now the market's imploding again. But when we look back at this chart, okay, there'll be another rally somewhere in here that lasts a few weeks, maybe a month or two. So how are we going to address that? We will not lose sight of the fact that it's a counter trend bear market rally. that will set up our opportunity to put shorts out for positioning, something I haven't done in decades. You cannot short the market for positioning when the Fed's adding liquidity. You can begin to short the market for positioning purposes when the Fed's reducing liquidity. I don't ever try to get on that short side at the beginning of the market collapse because the market volatility is insane and I don't need it. The first way to build alpha is to not be involved, let the market crash. I like to say that there is a step between being long and being short, and that step is cash. Partially, it's an emotional thing. You have to get your head right first. And going from long to short, you can go on tilt and blow up your whole portfolio, okay? Because when you go from long to short and then the market starts to go against you, you're still in the back of your mind, there's still that seed that you think the market is going to go up because you're Pavlovian and you're so used to the market going up. And so you just get chewed up. So we're going to take advantage of that. And we're going to put capital to work on the short side when the windows open. And I'm sharing that with you early. I'm trusting you to understand. I'm not putting shorts out now. Market's already cratered. The time to put shorts out is when it's rallying back and everyone thinks the bear market's over. That's when we put the shorts out. And I want to talk about it now because our stages of investing is to start getting yourself used to an idea on the whiteboard so you're ready to act when the algorithms tell us to execute. Those are my thoughts for the day, guys. I hope you find them helpful. I look forward to working with all of you on our virtual trading desk, our virtual hedge fund trading desk. We're going to get that fired up in the next 15, 20 minutes. And we'll look for these day trades again. We traded wheat yesterday, traded corn yesterday, natural gas. So I'm starting to trade commodities. All right, I'm going to look to do that again today and see if we can have some success trading those assets. If we can, we'll do them to a larger degree. But I think we've covered it. Hope you guys have a great trading session. And I look forward to seeing you in the Slack trading room.